The next reading is titled A New Look at the Role of Sovereign Credit Default Swaps. So just like a credit default swap has a contingent payoff to the protection buyer if the reference asset defaults. So there is a protection buyer, a protection seller, and a reference asset. If this asset defaults, the protection seller will make a payment to the protection buyer. The buyer has to pay an annual premium called the spread on the credit default swap. A sovereign credit default swap is a similar structure, only the reference asset is a treasury bond or a government bond. So a default on that bond essentially is a sovereign default. So like any credit default swap, a sovereign credit default swap is essentially an insurance contract that fulfills important market functions for hedging, speculation, and basis trading of sovereign credit risk. Hedging involves protecting against losses from credit events. So if I've lent a lot of money to this sovereign or to this country, then I may be interested in purchasing a sovereign credit default swap. Speculating involves naked positions to profit from negative or positive views on the sovereign outlook. Basis trading involves the exploiting the prices differences between the sovereign credit default swaps and the sovereign debt. As we studied earlier, the yield on the debt should be equal to the risk-free rate plus the premium on a credit default swap. So if there is any discrepancy, then again there may be an arbitrage opportunity or a basis trade to capture the discrepancy. The market for SCDS is dominated by dealer banks. So these are big banks that are generally dealers to the governments when the governments do OMOs, etc. So these banks have large exposure to sovereign risk. Non-dealer banks and investment banks or securities firms and hedge funds represent the most important players in the SCDS market. The market for SCDS is often considered more speculative, more volatile, and less transparent than sovereign bond markets. However, the fundamental economic factors that will drive an SCDS spread will be the same that will drive the government bond yields. So the government debt, the level of the debt, the current account deficit, the fiscal deficit, GDP growth, foreign reserves will all affect the yield of a government's bond or a sovereign bond in the bond market, and that is the same driver that will affect the SCDS spread. So if the government yields are going up, the SCDS spreads would also generally be going up as the default risk increases. Market microstructure characteristics include bid-ask spreads and trading volume. So this again is impacted like for any other financial instrument. So general financial market conditions, risk factors, periods of stress will again impact these bid-ask spreads also, like they will for other instruments. So although the sovereign credit default swaps and government bond markets may react to different financial market factors, the differences are either not statistically significant or we've seen that they generally move in the same direction. So generally what we can conclude is from the data available that the spreads move in tandem or as expected with government yields or government bond yields. Negative perceptions about the sovereign credit default swap include a perceived slower speed of incorporating new information, higher volatility in this market, spillover effects of risk, enhanced volatility, increased costs of borrowings for the sovereigns or increased costs in the underlying bond markets, and overshooting of spreads. Now, observations in reality do not support the majority of these negative perceptions that we've discussed. So we'll see them one by one. The Hasbrouck statistic, which is a quantified measure of the speed of incorporating new information from the SCDS market and the government bonds market. A statistic greater than 0.5 implies that SCDS incorporate information faster. So if there is a new information about a sovereign or new data, then generally it gets reflected in the credit spreads faster than it gets reflected in the government bond yields. So spreads go up or go down faster than bond yields going up or down. So the slower speed of incorporating new information is actually not seen to really happen in the markets, as the SCDS market appears to incorporate new information faster relative to the sovereign bond markets in many markets. Both the SCDS market and the underlying government bond market exhibit significant dependence on economic and financial market risk factors. Evidence of significant SCDS spread volatilities in certain countries exist, but it is challenging to attribute that volatility solely to the risks embedded in a SCDS as opposed to general market risk factors. So SCDS may be volatile in some markets. However, there may be volatility in all other metrics also, or the general market factors may be such that the volatility is there. So calling SCDS spreads particularly volatile or additionally volatile, as is a common negative perception, is generally not the case. The tests further do not support the argument that the sovereign credit default swap spreads increase the cost of sovereign bond funding. So existence of these spreads or of these markets hasn't necessarily seen or hasn't significantly seen to improve the cost of borrowing for the sovereigns, which is another negative perception. Now there are certain theories that support the ban on naked SCDS protection buying. That is, if you don't have any exposure to a sovereign, let's say a country A, if you have given a loan, then you are justified in buying protection. But if you have not given a loan, then naked buying of protection should be banned, is what some models say. The reason is that if you buy too much protection, then the spreads will go up. As the CDS spread goes up, it may raise the cost of borrowing for that sovereign. So the reason cited by these models is to reduce the volatility in borrowing costs, avoid higher government funding costs and fiscal problems. There should be a ban on naked SCDS protection buying. If you've lent to the sovereign, you can buy, but otherwise you should not be allowed to buy. Empirical research suggests that such a ban would reduce the liquidity in the SCDS market, hinder price discovery, increase price volatility, and may cause the purchasers of SCDS protection to withdraw from the SCDS market. So the market may not remain at all if you put such bans. Alternatives to SCDS. So if you can't buy protection by buying a sovereign credit default swap, you may buy protection or you may buy a CDS against a large financial institution and probably short government bond futures. These are other ways to take the same exposure as longing in SCDS would. So a large financial institution will also be correlated, or the movement of spreads will be correlated to the government or sovereign CDS. These proxies, however, are seen to be more expensive and provide less precise hedges, and are again generally not available in many emerging market economies. Another alternative is a temporary trading ban. So don't have a ban on buying protection all the time, but especially when you think that times are volatile and there may be excessive speculation, So for those periods, there should be a temporary trading ban. However, this will again result in reduced market liquidity with many of the same negative consequences as permanent bans would have. Another alternative to a ban that has been proposed is central clearing through a central counterparty. So what this would do is that it would again reduce counterparty risk, give the benefits of multilateral netting, initial variation margin requirements, and a loss share mechanism for extreme losses. So if there is a central counterparty, then to some extent, even if a buyer is buying credit or buying insurance, then his payments are secure. That is, if the sovereign actually defaults, the central counterparty will have the responsibility of making the contingent payment available to the protection buyer. So again, if the central counterparty exists, then that may further enhance liquidity, increase margining requirements, reduce speculative activity, or reduce a very high increase in spreads. Central counterparties, however, are reluctant to clear SCDS centrally, mainly due to the wrong way risk concerns. So the protection seller will have to deposit some margin with the central counterparty, because if the government defaults or the government bond default, then the seller will have to make good the payment to the buyer. So to ensure this performance of the trade may become a little difficult for the central counterparty in the case of a government default. So when the government defaults, the seller will also very likely be in a stressed position or will also be in a default. Hence, for him to make good this payment to the buyer may be difficult. So there is significant risk in the case of default, or this is the wrong way risk. So when the bond is defaulting or when the government is defaulting, the seller's credit quality also deteriorates. If the seller's credit quality improved when the government bond defaulted or the government's quality deteriorated, then that would be a right way risk. This, however, would be a wrong way risk, and hence, even though it may require the seller to put up some margin, that margin may not be enough in the time of default, and the seller may not be able to make good the payment of the buyer, and the due would then fall on the central counterparty. So CCPs are reluctant to clear these trades centrally for the wrong way risk concerns. Another alternative is of a bilateral margin posting, which would lower counterparty risk but increase the cost of using the SCDS market. So again, some margining requirement we can put through even without a central counterparty, which can again have a similar type of effect or a similar benefit. So that was about the understanding of sovereign credit default swaps and the dynamics of the SCDS market. The second last reading of current issues will talk about capital planning at large bank holding companies. So the Federal Reserve's capital plan rule mandates all top tier US domiciled bank holding companies with consolidated assets equal to or greater than $50 billion to develop and maintain an effective and robust internal capital plan for evaluating and assessing their capital adequacy. That is, in stress times or even in times of big losses, these companies should have enough capital so as to sustain the losses and not go bankrupt. There are 7 principles on which the Federal Reserve assesses the effectiveness of a holding company's internal capital planning. This is known as the capital adequacy process. So the 7 principles are related to: first, risk management foundation; second, is the resource and loss estimation methods employed. Third is the capital adequacy. Fourth is capital planning, internal controls and policies, and governance oversight. So you don't have to remember the details of each of these principles, but know that the capital adequacy process is designed along these 7 guidelines that require particular focus. Bank holding companies should develop a process to effectively identify all of their risk exposures on a firm-wide basis. They should establish a mechanism for a comprehensive, independent, and regular review and validation of all models used for capital adequacy planning. BHCs should have boards actively involved in the evaluating and approving their internal capital adequacy plans. They should develop a capital policy that clearly defines the principles and guidelines for capital goals, issuance, usage, and distributions. Stress testing and stress scenario design should be based on a variety of factors encompassing all the risk exposures faced by a bank holding company on a firm-wide basis, with the option of utilizing various quantitative and qualitative methods. BHCs should use loss estimation methodologies which are based on sound theoretical and empirical foundations. They should use a combination of inputs in order to develop loss estimates from operational risk. In order to estimate the counterparty credit risk, BHCs mostly use probabilistic or deterministic approaches. BHCs using a probabilistic approach should offer evidence of generating probable scenarios stronger than past observed events. So whatever losses have been seen in the past, in your future scenarios at least, you should cover as much, and your losses or your loss scenarios should be even more stringent than past observed losses. BHCs using a deterministic approach should generate again a wide range of stress scenarios. While estimating pre-provision net revenue projection methodologies, bank holding companies should pay particular attention to interrelationships amongst numerous relevant variables such as revenues, expenses, and on and off balance sheet items within a given scenario. So pre-provision net revenue is the revenue before any credit losses have been taken into account. After the pre-provisioning revenue, there is a provisioning line that will account for the defaults that have happened in this pre-period, and which will further give us the net income. So pre-provisioning is before any credit defaults or credit losses. Methodologies used for projecting net income should incorporate ongoing, current, and projected balance sheet positions. Bank holding companies should project non-interest income in the light of stated risk scenarios and business strategies. Non-interest income from a bank comes from fee income, that is investment banking income, treasury income, trading profits, the proprietary trading, etc. If it generates any profits, will all come in non-interest income. So these should be projected in the light of stated risk. That is, what was positive this period could very well be negative in the coming period. BHCs should have a well-defined process in place to develop projections of revenues, expenses, losses, on and off balance sheet items, and risk-weighted assets in an enterprise-wide scenario analysis. Projections should be based on sound underlying assumptions, interactions, and factors, and the estimates should be scrutinized, documented, and reported. So essentially, after the credit crisis of 2007-2008, regulation has become more strict as to the sufficiency of capital and the capital adequacy process. So again, more stringent and more defined procedures have now been laid out for big banks and big holding companies. These are companies that have assets with more than $50 billion. That is, a default or a failure of any of these entities can actually cause a systemic crisis. Hence, these entities are now needed to have further more stringent capital adequacy requirements so that even under stressed case losses, they don't go bankrupt. The final reading in current issues talks about sovereign credit worthiness and financial stability. So in this reading, we'll get a brief overview of the conditions and the theories behind the financial crisis of 2008. So what we've seen is that there are three key initial conditions that contributed to the global economic crisis. First, there was insufficient capital, high leverage, and large maturity and currency mismatches of the banking sector of major developed economies. Major sovereigns accumulated insufficient reserves during boom times to fully fund all long-term obligations during the financial crisis. So they had insufficient reserves to make good their payments during the crisis. Leverage was high, capital was insufficient, and we did not accumulate reserves during good times. There was a very high level of integration in the global financial system amongst sovereigns and financial institutions that exacerbated the crisis. So the crisis at one end of the world quickly spread to the other because there was interlinkages, there were loans given from one country to the other. So if one country defaulted, that quickly spread to the entire world. Three primary ways in which the risks from the financial sector can be transmitted to the sovereigns or can be transmitted to governments is, first, improper government policies as a result of one-off boosts to the fiscal balances from financial institutions. So if the government has been spending too much because it got a lot of money from financial institutions, a lot of banks bought government securities or government treasuries, and hence the government's finances were boosted because of the money from financial institutions. Then when these financial institutions would come under trouble, it would mean repayments from the governments also, or it would impact the sovereigns as well. Lending constraints of financial institutions can result in larger public sector deficit and deteriorating sovereign creditworthiness. So if the banks cannot buy into your bonds or the banks cannot lend more to the governments, then again, that may mean that you will not be able to fund all your expenses or fund all your programs. So it can also impact sovereign creditworthiness and result in higher deficits. Thirdly, many a times governments may simply need to support struggling financial institutions. So governments may need to provide funds to the financial sector in order to preserve financial stability. So these are some ways in which problems in the financial sector can cause problems in sovereigns or can cause problems in the governments. 5 ways in which sovereign risk can be transmitted to the financial sector is if the portfolio exposures of financial institutions to both domestic and foreign sovereign risk is high through their holding of sovereign bonds, then again, as sovereign bonds correct, the financial institutions will also see a loss. Funding conditions such as the availability of eligible collateral declines when sovereign risk increases, reducing a bank's funding capacity. So if there was no sovereign risk, then sovereign bonds could be collateralized, or you can give a government bond and borrow against the government bond. However, if the sovereign risk increases, then that sovereign bond will not be accepted as collateral in the repo market. Hence, your ability to fund against that bond will also decline. So, funding conditions will become tougher for the financial sector as well. Sovereign capacity to assist will go down as weaker sovereigns have reduced capacity to provide assistance to banks under pressure, increasing the credit risk. High levels of government debt may result in the phenomenon of crowding out, where the cost of borrowing for the private sector becomes so high or becomes very high as the government itself is willing to borrow at a high cost. So if the government is borrowing at 10-11%, then the private sector in that country will have to borrow at 14-15%, at which businesses may not be sustainable and borrowing may not happen. So again, the credit growth of banks and the profit growth of banks may be hindered. Finally, a loss of market confidence in sovereign debt may lead to fiscal consolidation. So the country itself may come under pressure to boost its financing, reduce expenditure, increase savings, increase taxes, which on the whole will be detrimental to the economy, which will reduce credit growth and reduce the demand for money, hence impacting the banking sector or the financial sector. So risks from the financial sector can be transmitted to sovereigns and vice versa, as we've seen in the last two slides. So during 2002 to 2007, in the period leading up to the economic crisis, what we saw was that sovereign debt to GDP ratios were within sustainable levels. They were not very high. Bond yields were low, sovereign ratings were good, and bank profitability was increasing each year. Banks became heavily dependent on access to cheap short-term funding, and as a result did not build up adequate liquidity reserves. Factors that contributed to the crisis was first, a failure by markets to recognize the significant rise in private credit to GDP ratios and the real estate prices above their long-term trends. So as that started to correct, as real estate prices started to correct, there were defaults on the mortgages because the private credit was very high and the private earnings or incomes were not as high, and hence these loans could not get repaid, and there started to be losses on the mortgage portfolios of banks. Secondly, a continued expansion of business cycles which led to higher public sector account balances. So government deficits, that is the fiscal deficit, had also become highly negative in the US, such that expenditure was happening to an extent higher than the revenues, further putting a strain on capital requirements and liquidity. Finally, from 2002 to 2007, increasing asset prices and real estate prices caused governments to continue to spend freely, as there was a wealth effect, as the value of government assets, the value of all assets was still going up, so there was no cause of concern. During the financial crisis, that is from 2007 to 2012, sovereign creditworthiness was called into question, resulting in negative correlations of rising sovereign CDS spreads with declining bank spreads. So until 2009, the probability of sovereign default was higher, so sovereign spreads inched up, whereas the bank spreads or bank CDS spreads were declining because people were shifting their assets or taking out of government securities and putting in banks. Beginning in late 2009, as the crisis deepened, this correlation turned positive. That is, now from 2009 to 2012, spreads across the board went up. Spreads on sovereigns also went up, spreads on banks also went up. That is, the market recognized this lack of capital and placed a higher price on the credit risk of these institutions. During the financial crisis, we saw that the bank's foreign claims of sovereigns declined along with a decline in public sector debt. So there were three reasons for the decline. First, some of the sovereign debt that matured on the bank's balance sheet was not renewed, so banks did not take further exposure to the sovereigns. Second, banks already marked down the value of sovereign debt to market value. The market value of sovereign debt had come down. And third, banks either sold a portion of the foreign government debt to the European Central Bank or to the domestic banks of the sovereign governments from where they had or on which they had exposure. So this is what we saw what happened from 2007 to 2011. During 2011, banks' exposures to foreign public sector debt remained elevated, while foreign portfolios of euro area banks remained concentrated in the riskier eurozone sovereign debt. So, debt of Italy, Spain, Greece was still a major portion of the bank's exposure to the eurozone. By 2012, the global financial system had become strongly integrated, wherein decisions in one jurisdiction could significantly affect economic and financial developments in other regions. Rebuilding confidence in the sovereigns had become paramount. So this was the time when Greece defaulted on its debt. There was risk that Spain could also default, Italy could also follow, so on and so forth. The crisis, as we know in hindsight, was averted by a flush of liquidity and quantitative easing by federal governments. A restructuring plan was put in place for various stressed sovereigns, and many other steps were taken so as to restore public confidence in the sovereign debt and in sovereigns. Several policy recommendations came out of the crisis so as to mitigate the spread of future crises. That is, first of all, regulations should set a floor for the amount of leverage any institution or sovereign can take. Banks should apply a more granular approach in distinguishing among sovereign risk, applying a higher risk weighting for higher risk sovereigns. That is, sovereigns that have borrowed more, have more deficits, etc. In the short term, governments need to implement actions to reduce their high indebtedness by fiscal consolidations, timely reforms, and financing backstops in order to maintain investor confidence. In the long term, governments should provide a counter-cyclical policy approach in order to remain creditworthy. So immediately, we needed reforms, we needed to cut down on wasteful expenditure, we needed to increase sources of revenue, etc. And for the long term, we should start saving up in good times so that in bad times we have sufficient capital and we don't go bankrupt. So that was a brief review of what happened from 2007 to 2012, where the financial system and the sovereigns came on the brink of default, and what are the policy recommendations that come out from the crisis. So that was about the review on current issues in financial markets. It is a significant weight on the exam, a relatively theoretical topic, so should not be a big trouble answering these questions with 4 choices on hand. Make sure that you read through the concepts once. You don't have to remember the exact dates and the exact regulations, but understanding the spirit and the concepts behind the theories is more important. So just go through it once again closer to the exam so that you remember the concepts and you can reproduce them on the day of the exam. It may look easy, it may look theoretical, but it still is a weight on the exam, so we have to ensure that we give these reviews and these readings the necessary attention. So thanks a lot and all the best for the exam.